Good day, guys. Welcome to the investment analysis. Our case study today will be social media companies or ad-based platforms. These are platforms that provide a free service to its users and generate revenue by selling data generated on these platforms from their users to advertisers. Now, the first company we'll be looking at is Meta, the company formerly known as Facebook. It changed its name. It went through a bit of a corporate change. Now, this was basically to signify that it's no longer just a social media company. It is more of a diversified tech company. To a degree, it is true. I mean, it does have a diversified range of services. I mean, the bulk of its revenue still comes from ad-based revenue. However, it is diversifying slowly but surely into other areas. For example, streaming, commerce, as well as gaming, and of course, hardware in the form of its metaverse, Oculus, what is it, goggles. Uh, but before we start with the analysis, I just want to draw your attention to a little bit of background information of how the analysis will operate. Now, before you do an analysis, there are three main areas that you will need to research. And this analysis that we did on this case study, we did three. We basically researched three main areas. Now, these areas are financial performance, growth and profitability, financial position, which is the strength of the balance sheet, as well as liquidity, the ability of a company to generate cash flow from its operations. Now, these three elements are very important because they will help you justify an investment as well as justify a valuation. Okay. More background. All the financial information, the financial statements of each company was obtained from the relevant company's investor relations website. And we will be looking at mainly three financial periods, which is 2018, 2019, and 2020. This is for all the companies in this industry. Furthermore, 2021 is not yet available. The financial statements have not yet been published, but probably be published in February of 2021. February of 2022, sorry, February of 2022. I keep forgetting that we are in 2022. February of 2022, that's when they'll probably be published. One last background point, please bear with me. Net income or net profit. Now, for net income or net profit, I prefer to use the net income or net profit, depending on which term you use. They're basically the same thing, net income, net profit. Same thing, just different terms. I prefer to use the net income before taxes. Why? Because taxes are very unique to each other, and the relationship between income and taxes are exclusive. Because just because you make income doesn't mean you're gonna pay taxes for these tech companies. I mean, a lot of them make billions and billions of dollars in profits, but virtually pay minimal to no taxes, and that is because of the legal complexities of the taxing codes that provide companies with legal loopholes to pay no tax or very, very low tax. So that tax relationship creates a bit of volatility and distorts comparisons a bit. So that's why I prefer income or net income before taxes. Okay, enough of the background. Now let's get into the meat of the case study. First company, Meta. Now, looking at Meta, first we'll be looking at its financial performance. So that's growth and profitability. On the growth and profitability side, we start off first with net income margin. Now, this ratio in a nutshell is basically the ability of a company to turn revenue into profit. So with Meta's case, for each dollar of revenue it generates, it's able to convert that dollar on average into 40% or 40 cents of profits. The margins have been fairly impressive. I mean, slight deterioration in 2019, but a massive bounce back in 2020. Now, any deterioration of margins can be accepted, considering the industry these companies operate in. They do need to spend heavily on R&D costs as well as other costs relevant to its infrastructure and IT services to host this platform. So you do not mind to see a bit of a deterioration, but any deterioration should not be sustained or prolonged, and all those costs incurred or the increase in costs incurred should be justified in the form of increased revenue and profitability. So we knew the duration was slightly due to the fact that okay, there has been a bit of an increase in costs. Okay, now looking at costs, what I do like from 2018 to 2020 is that cost of revenues have been increasing, but you can see they're increasing at a slowing or a decreasing rate. I'm happy with that because it shows me cost control. Yes, the entity is decreasing costs. Yeah, they are growing, but it's at a slowing rate, so they're controlling costs. So they're not growing or spending for the sake of spending. They're spending for the sake of growing. All right, we're gonna get to the growth in net income and revenue pretty soon. The growth in R&D has been growing at an upward trend. I do expect that because I mean this industry is very R&D heavy. To innovate, you need to spend on innovation, basically R&D. Sales and marketing, pretty of a bit of a minuscule expenditure because it's been pretty stagnant on average on 14% over the past 2 years. So happy with that. That tells me cost control. Uh, Research and development has been, as a percentage of revenue, has been increasing at a upward trend, more or less in line with the industry. Again, very happy. Again, very happy. I want to see increase in R&D. I do want to see increase in R&D, but it needs to be justified. Just because I'm seeing increase in R&D does not automatically mean that I am happy. It needs to be justified. Now, are all these cost increases, have they been justified? Yes, they have been, in my view, because you look, revenue has grown by a compound rate of 29% over the past 3 years. Decreased a bit in 2020, the rate, of course, but I'm still happy at where Meta has kept their revenue. That to me as an investor shows me stability, shows me that even though there has been up increases in costs, those costs have been justified. So they're not growing for the sake of growth, they're growing for the sake of profitability. Net income justified by the fact that revenue has been increasing steadily. Some costs have either been stagnant or increasing at a downward trend, leading me to a beautiful 13% compound growth over the past 3 years. So, am I happy with Meta's profitability? Yeah, I'm happy. You know, the company generates what, 85 billion. This is billion. You know, remember all these financial figures are rounded off in millions. So on that 86,000 it times a million. So that will give me $85 billion worth of revenue generated in 2020. That is very good. It generated 85 billion, but with that 85 billion, it still managed to grow net income at 17% and achieve a pretty strong margin of 39%. So it managed to grow revenue, but turn that revenue into profits. Happy. Good cost control. Costs that are spent are justified. So the good margins are driven by good cost control as well as increase in revenue. And costs that have increased, R&D as a percentage of revenue or R&D growth, they have been justified. So I'm happy with that profitability. Now again with return on equity. Return on equity, it's a profitability measure, but more importantly, it tells you how efficient a company is or how efficient a company has been in turning shareholder capital into returns. happy with this because the S&P 500 over the same 3-year period on average returned about 13%. Meta over the same period returned an average of 27%. So I am more than happy with how Meta has been using shareholders' equity. Now, this is a good indicator of the fact the company is productive and efficient in the use of shareholders' capital. Now we're moving on to financial performance. Current ratio and debt to equity ratio. These are two very important balance sheet measures. All right, now starting with current ratio. Now, just on an overall basis of the balance sheet of these tech companies, they tend to be very good. Their balance sheets tend to be very good because these companies, they operate in a very asset light, cash heavy industry. What that means is that they do not need to buy heavy manufacturing or production machinery or equipment. The equipment they need is maybe data centers, spending on data centers, headquarters, other support and network infrastructure to um, support the users on its platform and to maintain and improve its platform. So yes, they do spend on assets, but it's not heavy assets. It's very specialized, still very expensive assets, but it is not those heavy machinery. So they tend to be asset light but cash heavy. So what that means is that they don't need to take out that much debt, and they tend to have large amounts of cash, which drives, and we will see with the issue as we analyze, which drives the good performance of its financial position. So the current ratio of Meta, now the current ratio, as a simple example that I can give, current ratio is basically how much current liquid assets do you have compared to short-term current liabilities. So it's basically short-term assets to short-term liabilities. So for each short-term liability, how much short-term assets do you have? Give you to simplify it, you can think of it as an individual. Right? Things such as your credit card debt. Maybe you owe somebody money, you have to pay them quite quickly, so within the next 30 to 90 days. That is short-term debt for an individual. For companies, however, short-term debt is within 12 months. So for us, so for individuals, it would be within 90 days, within 60 days. That's basically our short-term debt was. Now, so for your credit card debt, when you owe somebody all those short-term liabilities of that nature, how much liquid assets do you have? Now, liquid assets could be short-term fixed deposits, actual cash, other short-term market securities that you have. So, yeah, other short-term securities that you have. How much of that do you have relative to your liabilities? Now, Facebook, Meta. Oh my goodness. Well, that's a dollar into the mispronunciation job. Uh, Meta in 2020 had 5 liquid assets for each liquid liability. So there are 5 times the liquid assets of their liability, which is very good. So they can pay their short-term liabilities, their current liabilities, 5 times over. That is wickedly good. Slight decrease in 2019, but heavy improvement in 2020. On average, it's sitting at about over 5.5. This is a very, very, very good ratio, and is driven mainly by the heavy mountain truckloads of cash on the balance sheet of this company. This is very, very good by Meta. This shows me that it is a very liquid company. It means it has enough cash, enough short-term liquid assets cover their liabilities on average 5 times over. 2020, 5 times over. Debt to equity tells me the long-term financial position or financial health of the company. So it's basically how much is debt as a percentage of equity. So how much debt do you hold relative to your net worth? Meta on average holds 24%, 2020 is also 24%. So it holds 24%. debt relative to its net worth. So 24% of its net worth is attributable to. Very, very, very good. A normal ratio, normally it will be 1 to 1. However, at 24, so it's 1 to 1, meaning 100% for each. So basically $1 for $1 of debt for $1 of your net worth. Facebook holds 24 cents of debt relative to $1 of its net worth. So it's very good. This is very, very good. A current ratio, just going back there, a normal current ratio would be on a basis of um, 1 to 2. So for each liability of 1 to 2. So for each liability you hold, also for each liability you hold, my vocabulary is leaving me today. So for each liability you hold 2 assets. And Facebook is at 5. Meta is at 5. Goodness, it's gonna take me a while to get used to this whole meta thing. Sorry for that. So that's another dollar into the mispronunciation job. So 5 for meta. So this is a very, 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 very good in terms of financial position, these two ratios. What they tell me is that not only is Meta liquid in reference to its current ratio, but it has a strong financial position, does not hold that much debt, so it does not have a lot of credit risk on its balance sheet. Very good as an investor. So you're basically buying a company that has a lot of cash, that's very liquid, and holds very low debt. So very low financial risk, very low risk for you as the investor. Okay, so financial position, a big tick mark there. I love it. Now we go to the liquidity. So the cash, so basically the cash ratios, the cash position of the company. I'll get more detail into that, what that means. Cash from operating margins. Now what this means is the net cash from operating activities as a percentage of revenue. Meaning for each dollar of revenue Facebook generates, so that's my revenue, how much of that can it convert to actual cash from operations? 45% or 45 cents. That's in 2020. On average, it's about 50 cents or 50%. Now that is very good. That is wickedly good. That is way too good. Again, these companies do operate in a very high margin industry that is very cash heavy. So this does make sense, but it is still very, very good. Again, as an investor, you're looking at this and saying, I'm buying a very cash rich company. So at 45% or 45 cents per dollar of revenue is very good. Now, slight deterioration from 52 to 1 to 45. Slight deterioration, but as we know, as we talked about with the profitability, Facebook has been increasing its cost, or it has been still spending a significant, even though some costs are still spending a significant amount of cash on them, and there are certain costs that are increased. So you don't mind to see a slight deterioration as long as it can be justified. Now, can those deterioration in the cash from operations margin be justified? Yeah, in a way it can, because you look at the sufficiency of cash flow. Now this is basically, does the entity generate sufficient cash flow from operations to pay um, your lenders, so your borrowers, people who lend you money, to buy assets and other investing activities, as well as to reward shareholders, so paying shareholders back in the form of dividends or buybacks? And the answer is yes, still can. So slight deterioration, but you can live with that. It is justified by the fact that there has been an increase in costs. Those that are decreased are still quite significant, but all these increases in costs are justified because my revenues are growing, my income is growing, my margins are pretty strong. I still have a sufficiency. I still have a cash margin that is that's well on average 50% or 50%. So that means half of all revenue I generate after cash, which is very good from operations. So what this tells me that Facebook's operations are very strong. Not only can they generate cash, but they have enough cash to pay to pay and basically cover all operations, including paying lenders, rewarding shareholders, as well as buying assets and investing cash to grow the company into the future. So again, what this tells me is that the company is very liquid. Its operations generate cash and has enough cash to cover all operations to sustain and grow the entity. So again, a very big tick mark there. The dividend yield or the buyback yield. Now, these tech companies, these social media ad-based platform companies, it's very common for them not to pay dividends but to do buybacks. Makes sense considering that their share makes sense because they trade at very ridiculous multiples. So their share prices are very high. So a better return on shareholder investment is probably buyback rather than dividends. So it will explain this is not a yield, this is not a dividend yield, but a buyback yield. So buybacks as a percentage of net cash from operations. So of the cash you generate from operations, how much of that are you paying in dividends? 44%, 12 and 16%. Decreasing rate, but you do expect that. Because there are instances where the company just wants to retain a bit of money to be able to fund operations. I do not mind the decrease. Jumped a bit from 2019 to 2020. I do not mind the decrease considering how good the cash generation abilities has been. So Facebook, in my view, has been very efficient with the utilization of cash. I love it. I love it very much. On average, about 24%, the buyback yield. Now, this is very important, basically to give an indication of how well a company is using its cash, but also when you compare it to other companies. So I'm buying a company that generates or that pays me on average 24% yield, and you can compare it to another company, and you can just so it's basically a good comparison tool. It has a lot of value when you compare it to other companies. It gives you a bigger picture. So we'll come back to this ratio a bit later. It just has more value. You can extract more value from this ratio by comparing it to other companies. A P ratio of 27%. Now, P ratio is the price multiple. So, P ratio tells you how expensive is a stock. So, how much are you paying for earnings? So, for $1 of earnings, how much are you paying? 27 times. You're paying 27 times per $1 of earnings. You're paying $27 for each dollar of earnings. Quite expensive. Quite expensive. So that is how you determine if a stock is cheap or not cheap. You consider the price multiple, which is basically one leg. Because remember, the other leg is this analysis that we did. Profitability, financial performance, liquidity in terms of cash flow generation, return that it gives me, the yield. Those are the other legs. So this is just another leg that tells you how expensive is a stock. So relative to its performance, this is how expensive Facebook. This is how much you're paying for earnings. So again, you can extract more value from the PE ratio when compared to another company's PE ratio to determine how expensive is it. So you first determine how expensive is relative to its performance. At 27, for me, it is a bit expensive, but you consider the fact that companies in this industry are hitting at crazy multiples, and the fact that Facebook is a company that gives you $86 billion of revenue, 22% revenue growth, 17% net income growth, a 39% multiple, strong liquidity of 5-1. So you've got very a lot of current and liquid assets. You only have 24% of your net worth tied up in debt. 45% cash margin, and a sufficiency of cash flow of 1.35. Just to go by sufficiency of cash flow, 1.35, a good ratio should be 1 because it tells you you have just enough to cover all your to cover money needed to pay lenders, invest, as well as reward shareholders. So anything above 1 is wickedly good. So I'm paying 27 for all of that. And of course, very, very important, I'm paying for the fact that the company is very efficient in using its cash resources. It's really, really good and rewarding me with 16% of returns, of cash returns. So is 27 a lot? Again, for me, it's not. It's not a lot. It's pretty, it's pretty fair. It's a pretty fair price considering how much I'm paying, considering what I'm getting for what I'm paying. All right. Now I'm gonna have to compare it to other companies, and that will come at the end to justify any investment we might make. So just to recap quickly about Meta. Meta has very healthy margins. It has very, very healthy margins. It's very healthy in terms of its profitability performance. Good cost control, not spending just for the sake of spending. All costs increases are justified because they're leading to interest revenue as well as net income. Margins are fairly stable. Good return on equity above market returns for S&P 500. Strong balance sheet, very, very strong balance sheet with low debt and a lot of cash. It can generate cash from its operations. It's shown me that. On top of that, it does have enough cash to fund all operations of the business. Gives me a 16% yield at what I would consider is a very cheap price of a 27 multiple. All right. So Meta for me, it ticks all the boxes. I'm really, really, really in love with this company. It gets an A from me. All right. Now we're done with Meta. Quick look at how it just performed over the past year. I mean, it's performed really well. My goodness gracious. I mean, 33% returns for the past year. It's performed really well. Now, even though it did stumble a bit, I mean, this is that point I'm talking about, and that point is due to the fact that Meta went through what I would consider as a donkey excrement show in terms of regulatory scrutiny. When it was discovered that it's not good for teenage girls, it really tanked a bit. However, even though it tanked, that tanking for me was more of moral objection to the fact that the platform is not good for humans. So I want to watch my words very carefully because I'm sure a lot of people will consider me as very immoral. But here's the thing, all right? Even though those reports came out, it went through that donkey excrement of a show, of a horror show fest. The excrement did hit the fan, but but it's still a good company. It didn't lose any it didn't lose any users. I mean, how many people do you know after discovering the fact that Facebook and Instagram are not really good for teenage girls? How many people deleted their their Meta platform? Not a lot. So this is just moral outrage rather than financial outrage. From a financial point of view, from a growth point of view, from a future sustainability and progression point of view, Meta is still a good investment. Okay, now please take note of the disclaimer there. Now, we're done with Meta. Still a very good company. I like it. does have a bit of regulatory issues, but not enough, in my view, to derail its progression and growth. Ah, now with Meta, we're done. Moving on to Alphabet, company formerly known as Google. I don't know if you see a pattern going here with these tech companies changing their names. But anyway, company formerly known as Google. So also went through a corporate change. The reason same as Meta, wanted to justify there's no longer a search-based um, platform, that it offers more than just search. It offers, you've got Google Cloud, it offers enterprise software now, and other enterprise applications. It's in streaming, Google, YouTube. It's also in streaming as well, and hardware. So it just wanted to move away from the name that signifies that it's just a search or an ad-based platform, and more into a diversified tech company. True, because it does have a myriad of offerings. Even though search is still a very dominant revenue driver, it still does offer quite a bit more than just it does offer a bit more than just what's this thing? Oh, my words are leaving me today. It does offer more than just search. Okay, now let us analyze this company. First and foremost, that is a typo. That is a serious typo. I don't know how the hell that happened, but it happened nonetheless. Let's move on with life. That should be 25%. So the margin on average is 25%. 25%. Let's fix that. Let's see if we can fix that quickly. That is 25. You know what? Screw that. Looks like we cannot fix it. But try to fix it. Looks like we cannot fix it. But that's 25%. 25. Remember, that's 25%. I'm saying it a lot of times because I don't want people to come and say, "Oh, that's a folks, they don't know math." That's 25%. That's a typo from my part. So sorry for that. Net margin, very good, very good. Pretty stable. Pretty stable for the past 3 years. Averages to 25%. Very stable. I mean, I love how stable its margins are, and you will see how in love I am with this company. But it's amazing. I mean, stable margins. It basically increasing costs, but at a decreasing rate. You will look at R&D growth decreasing. Sales and marketing pretty stable and stagnant. You can see 12, 11, 10, stagnant. So same as Meta. Average of 11%. R&D as a percentage of revenue also stable. Keyword in what I've just said in the first 1 or 2 minutes is stable. Stable margin, stable cost basis. Now, you need to understand why this is the case, especially with the cost. Meta is expanding. I think, Alphabet is practically the only company in this industry, and you will see as we go on, that spends less than the industry averages. And that raised a bit of an eyebrow, because an investor, you'd be like, whoa, why are you spending so little on R&D? Why are all your costs going down? You should be spending more, to keep up with your competitors and the other big boys. But it isn't. And that can be down to basically one thing, Alphabet has matured a bit. It's no longer chasing growth. Like most companies, so it's not behaving like a startup, like a unicorn. No. It's matured. So it does not need to spend for the sake of spending. At this stage, it needs to spend to justify growth. Any expenditure needs to justify growth. Now, it has kept its costs on a tight leash. All right, some costs it doesn't really need to spend that much R&D. I mean, Alphabet is in a stage, in a cycle of its life where it's now realizing all the R&D that it has spent previously. You know, if you remember, Alphabet's spend on the Meta before even on the metaverse, right? It's spend on the metaverse, virtual reality and augmented reality. It's spend on that way before, way before even Meta came up with the name metaverse. It started to invest in it way before. So it's now just realizing that R&D. It doesn't need to spend any. It doesn't need to spend what it does not need to spend. So all spend in Meta all spend in Alphabet. When I look at these ratios, when I look at my analysis, that this represents a very mature company that's not chasing growth like a normal way, a startup or an or a newly listed company or a unicorn might. No, no, no. It's at the stage where any growth will need to justify any increase in expenditure. So I love this cost control. The fact that it's on a tight, it's not spending for the sake of spending. It's spending while keeping costs on a tight leash, resulting in very stable and steady margins, resulting in pretty decent revenue growth, very excellent growth in net income. And still, I mean, this company makes $182 billion in revenue. That is just wickedly insane. And on top of that, from the 182 billion, it does not spend it wisely. We can see that with stable growth, very healthy margins, growth in sales result in a very good net income. So it increases this. So not only is it not only does it keep its cost control intact, it's turning its revenue into net income. So this is very good from Alphabet. I love it. All expenditure needs to justify growth. I love this. I love this. It's a very mature company. When I go to my return on equity, how productive, how efficient has Alphabet been in converting shareholders' capital into returns? S&P 500 over the same period returned 13%. Alphabet has returned 20%. Very good. Very good. Above market return. Above market return. Yeah. Anyway, a bit of a tongue twister there. But again, very good. Healthy margins, good cost control, and it's not the fact that it's falling behind the big boys. No. Really spend heavily on things that some of these companies are spending into. Alphabet already been spending on that. AI, the metaverse. If you remember with Google Glass, I don't know how many of you remember. Google Glass was basically the first iteration of the Oculus headphones. The virtual reality or augmented reality headphones. It was the first iteration of that, and Alphabet spent that way before when it was still considered uncool. Now it's cool. Now companies want to venture into this, offering augmented reality in your glasses. So, and Google and Alphabet, well, back then it was Google, so Alphabet did that long ago. So again, I love this. I love this company. I love it. Stable margins, good cost control, not chasing revenue by unnecessary expenditure. All expenditure needs to justify growth. Solid growth in net income. Very impressive revenue that actually competes with some countries' GDP. It makes more money in a year than some countries. I mean, my goodness gracious, this is fantastic. Solid market rate of returns. I love it. So, from a profitability point of view, big check mark. Current ratio. So now we're in the financial position. So, financial position, is this company solvent, liquid? Is it not bankrupt? Does it not have too much debt? Is it too much of a financial risk? Does it have a stable balance sheet. Let's see if it does it. Current ratio. Again, Alphabet operates in this ad-based social platform industry, which is basically asset light but cash heavy, like we explained with Meta. So its current ratio is mainly driven by the huge stacks of cash it has on its balance sheet. Very good. Now I explained the current ratio in detail in the in the meta-analysis on what it is. But a quick recap: current ratio in 2020, Alphabet has three liquid short-term current assets for each liability it holds, each short-term, each current, or each liquid liability it holds. That's very good. Again, you can just imagine for a person, imagine all your short-term debt, your credit card debt, money also have to pay really quick. Imagine if you've got, for each one of those debt, you've got 3 times the liquid asset of cash, the short-term investments and other short-term market securities. That is very, very good on a 3-to-1 basis in favor of assets. Very, very good. Shows me it's a very liquid company and a very, very strong indicator of balance sheet strength. Now the debt equity has increased a bit. Um, and you don't mind that. Again, I do not mind that it has been increasing a bit. And that again is mainly due to the fact that it's been taking on a bit more debt and the cash has been going down. But even though it's been increasing, it's still at 44% in 2020. In 2020, right? In 2020, it's still at 44%, which is basically 44 cents for each for your net worth. So for each dollar of net worth that Alphabet is worth, it only holds 44 cents in debt. That is very good. You can just imagine that as a human being, Imagine you hold for your net worth. Imagine for each dollar of net worth you are worth, only 44 cents of that is debt. That is incredibly good. That is still very good. I mean, it has increased, but you don't mind it taking on a bit more debt because it does have the balance sheet for it. It does have the revenue for it. It does have the good, prudent financial discipline for it as well. The good um, top and bottom line goal for it. So you don't mind it taking a bit of debt because again, I feel like this bit of debt is justified because it still has strong liquidity. Even though it's taking on more debt, it's still in the long term stable in a stable financial position. It's taking on more debt, but I mean it's only 40. Debt only represents 44% of its net worth. It's really not that much. So again, increase, but still good. So again, just to summarize, Alphabet's its balance sheet not as strong as Facebook's, but then again, Facebook is only an $86 billion company in terms of revenue, and Alphabet is a $183 billion company in revenue, so it's more than double the size. So it can afford to take on a bit more debt. So I'm happy with it. So what the debt ratios, the current ratio and the debt to equity ratio, what they tell me is that Alphabet has a strong, a stable um, by financial position. It has a good balance sheet. It has a very, very, very good balance sheet. Yeah, I'm drooling at the current moment because wow, these are really, really, really good numbers. You look at the you look at the debt to risk relationship as well. The increased debt is, as you can see, followed by the increase in return. So it's very efficient with the use of its balance sheet to return equity. It's very efficient, productive with its income statement to return equity as well. So with its financial performance, also return equity as well. So I mean, very good. Let's move on to the cash liquidity ratios. Looking at my liquidity ratios, I have the cash from operations margin, cash from operations margins, or the net cash from operating activities margins. Same thing. Very good. Very good. My goodness. And it's basically stable, but I mean, knockoff from 2019, but not really that big, and a massive improvement of 2 percentage points from 2019 to 2020, average of 35%. Lovely. So what this tells me is that for each dollar of revenue Alphabet generates, it's able to convert that. For each dollar of revenue it has, it converts it to 36 cents, or 36% to cash from operations. So what this tells me is that Alphabet's operations can convert revenue into cash. At 36 cents, it's still good. I mean, 36% on 183 billion is a lot of billions. But very good, stable and strong. So not only is it stable, strong, as you can see, there has been a massive improvement, a bounce back from 2019 to 2020, but it's able to convert its operations into cash. Lovely. Supported by the fact that you look at the sufficiency of cash flow. Does it have sufficient cash flow from operations to pay lenders, reward your shareholders, as well as for investing activities, so to invest for future growth? Yes, it does. It's sitting at 1.16, average of 1.17. Very good. Remember, a good everything above one is fantastic. Everything above one tells you everything at one tells you have sufficient. Everything above one tells you have more than efficient. So it has more than efficient. This is very good. Efficient use of cash flow. So not only can it generate cash from operations, but it has enough cash flow to pay lenders, invest in the platform, in the operations for future growth, future prosperity. Blah, blah, vocabulary today, as well as enough to reward your shareholders. Efficient use of cash, I love it. Supported by a strong balance sheet, good cost control, stable margins, growth in the top and bottom line. Lovely. The yield has been a bit all over the place, but we don't mind it. Still on average over the past few years, returned 33% in the form of a buyback. Remember, Alphabet, like Meta, doesn't pay dividends, but it does do buybacks. So we're doing buybacks as a percentage of net cash flow from operations. So of the cash you have from operations, how much of that are you giving back to shareholders? And this is very good. Very good. Um, Again, this ratio does hold more value when compared to other companies, and we will do that later on. But again, very good. So as a shareholder, I would love this. And then let's look at that. The P ratio. That thing is a lot. P ratio, how expensive is the stock? So for each dollar of earnings, how much are you paying above it? So for each dollar of earnings, you pay 20 or $30. For each dollar of earnings, you pay $30 to own Alphabet. That is a lot. That is a lot. Is it justified? You could say that, but wow, it's a lot. Yes, I mean, stable margins, good cost control, growth in the top and bottom line, above market returns, solid balance sheet, efficient use of cash, able to generate cash from the operations. I'm getting some I'm getting some reward from the company itself in the form of a buyback. I feel like that's a bit too steep. I mean, the operations do justify it a bit, but not. I mean, that's just too much for me. That's just too rich for my blood. For other investors, they could look at this and say, "Yeah, that I'm justified." But for me, that's just too rich for my blood. But overall, just in conclusion, as we saw with Alphabet, stable margins, good cost control, growth in top and bottom line, above market returns in the form of return on equity, ROE, solid balance sheet, ability for the to use the operators to generate cash, and sufficient cash available to pay lenders, to reward shareholders, as well as to invest. And it does give you a reward in the form of a buyback yield. But so it takes everything in terms of profitability, position, and liquidity, but it's just a bit too expensive at a P of 30 for my view. However, look at this return at 60% return. Many would say this justifies that 30. I mean, okay, maybe, but yeah, I mean, ugh, good too much of my blood. But anyway, good return. I mean, it's offered a really, really good return. I mean, it's been fantastic. But the question I think, and the same question could be asked about Meta, is 2020 was an exceptional year. I mean, can they maintain it in 2021? That's a good question, though. But again, a good performing stock. But for me, just too expensive. But that's enough from Alphabet. Baidu, we're in the Chinese section now. So Baidu is also listed on, I believe, it's on the Nasdaq or the NYSE, but it's listed on the American stock market. So Baidu, in a nutshell, is basically the Alphabet of China. Offers more or less the same services Alphabet offers. It's in search, it's in AI, as well as in cloud as well. And Alphabet is also operates in the same lines as well. So very, very good. So yeah, the Alphabet of China in a nutshell. All right, let's get to it. The analysis itself. All right, Baidu performance. Now, oh yeah, no, this is not the. Anyway, let's get to it. It's not very impressive. I mean, massive deterioration from 2018 to 2020. I mean, a horror show in 2019 where you have a negative margin. That basically means the company, Baidu, lost money in 2019. Actually had a net loss in 2019. Massive bounce back in 2020. Very impressive, very comforting. But I mean, Baidu has been in existence for quite some time. It's the Alphabet of China. This should not be happening, and there are reasons for that, and we're gonna get to the deterioration, why it happened, step for step, as well as the improvement as well. So now mainly we can see, cost of revenue has increased significantly. It decreased. Now that is very good, because that shows me that the company was probably saying to itself, we're spending way too much and these costs are not justified. So let's bring them back. Let's reel them in a bit. So that is bad. So that is bad considering it didn't justify growth in the form of net income or growth in revenue. You can see net income decreased in 2019 by 101%. Revenue only grew by a minuscule 4%, and leading together with the cost of revenue growing at a compound rate of 20% in 2019, really led you to have a negative 0.3% margin. R&D growth, growing consistently, not that bad. It's been pretty consistent, slight decrease, 2 basis points, a lot, but it again shows me the entity probably saw, okay, we're spending way too much than we need to, not justifying the spending that we do, not justifying growth in the top as well as bottom line. Not really gotten our margins. Sales and marketing stable at 10%. That is much expected. When companies tend to cut back on costs, the main thing they tend to cut first to be sales and marketing. So that I expect. R&D as a percentage, pretty fairly stable. Most of these companies keep them stable, so pretty stable. That's okay. Now, 2019, we've seen revenue growth did not justify the growth in costs as well as the expenditure in costs. And we've seen a reaction from that in the form of decreasing certain costs that the entity might be deemed excessive, and that thankfully has led to a recovery and a rebounding of the net margin. Revenue still increased, but pretty minuscule. Net income did increase. Very, very huge, a very, very, very huge increase. So in 2021, 2020 tells me is that the entity basically reined in costs. It stopped spending for the sake of spending. It grew revenue, even though very, very low, it still grew it enough to rebound net margins as well as increase the net income in totality. In total. Now, the other reason for this really, really bad performance is that Baidu is a Chinese tech. It operates mainly all of its income comes from the China. Now, unlike your Alphabet and Meta, who have the luxury of being able to operate outside, even though the US still accounts for a large part of its revenue, it still operates all over the world except China. But there's about over 7 billion people in the world. 1.4 billion of those are in China, so we can say what 5.6, 5.7-ish billion people Alphabet and Meta have access to. Well, all the other Western tech companies they have access to it. Baidu basically only has access to 1.4 billion. 1.4 is a lot, but it's still just 1.4. I mean, it's a finite amount of people, a finite amount of eyeballs, a finite amount of hours. Now, so it does have market risk in the form that it's overly too exposed to one market. It does have product risk in the form of it only offers mainly one product dominates revenue, which is search and ad-based revenue and ad-based revenue services. So when you have in China the fact that in China we have seen an explosion of other social media companies, ad-based companies, and these companies have been the competitors of Baidu. They have been eating into Baidu's margins, their market share as well. And because they're only limited to one market, they are disproportionately affected by market risk. You can see the fact of a slowdown in revenue as well as minuscule increases in revenue. So that is a bit of a warning, in my view, because yeah, you can control costs, which is very good, and you can stabilize them. But there's a point where if you start spending less below that point, you're basically losing pace with the big boys. So Baidu's financial performance, the picture it paints between 2018 to 2020, is one of a reactive measure to adverse market effects. So it's not one of growth story, it's one of reacting to competitors, reacting to the disproportionate risks it faces, product and market risk. Now, from a profitability point of view, it is profitable. But the question is, how much of this profit can it sustain? How much of this profit? How much of this profit can it sustain, and how much of it can it grow? So, and we have seen a struggle to protect its market share because other big boys in China are eating into its revenues, into its margins. So, from a profitability point of view, yeah, it's recovered, but the recovery it's more reactive, as well as we need to keep a close eye on competitions. Furthermore, on top of the market risk, on top of the product risk, is regulatory risk. Now, bear in mind, Meta and Alphabet also faces these risks, and I don't talk too much about them, but because they've been diversifying. So for product risk, Meta has been diversifying into the fact that it's now offering streaming. It has gaming platform to allow gamers onto its platform. Commerce, allowing influencers to sell products to their users, to their followers on its platform. You've got the Meta arm of the company and the metaverse arm of the company. And you can't see it, but metaverse, I'm putting in air quotes because just a quick side note, I'm getting a bit distracted, but I'm of the view that companies are now using this. I don't believe Meta is, but other companies are using the whole word metaverse to basically jack up their share price. But anyway, and saying we're a meta company or a metaverse company just to jack up their share price and get artificial excitement around their share price. But so Meta has been diversifying. It's offering a range, hardware services, in augmented reality and virtual reality headsets, commerce, gaming, streaming. It's offering more. Alphabet, it's in cloud. You've got the operating software, the Android software. You've got business enterprise offerings. You've got Google apps for businesses now. You've got cloud business. You've got consumer electronics as well. So they're diversified. Their product risk, their market risk, they are expanding heavily into other markets, excluding China. So they've got 5.67 other billion people to play around with. So they're diversifying to that. Where Baidu, it has that the product risk, market risk has a disproportionate effect on its operations. So that worries me. But yes, it gives me access to China. But in this case, where risk is increasing, how can the company promise profitability? How can it promise prosperity? It's a good sign that it has rebounded, but it's more reactive than, in my view, growing. It's more reactive because a lot of it comes from slashing prices. Because revenue still grew at 6%. That is, it's good, but it's mediocre at best. It still grew at that. So what the revenue growth, what the slashing in cost, yes, good cost control. But what they're telling me is you're spending way that you should have spent, as well as your decreasing costs to react to the fact that the other companies, the big boys, are eating into your margin because your revenue is only increasing at 6%. So it's more reactive than, I would say, an indicator of prosperity. Regulatory risk. Chinese companies are under a barrage. They are under a crowstorm of regulatory um, setbacks, and their share prices, you will see, has indicated that. So that will also eat a bit into profitability because companies might not grow at the rate they want to grow because regulatory risk basically just clip their wings and forces them to be in a box that the regulators want them to be in. So that is also scary, and that is also, in my view, weighing a bit. And that, in my view, should also weigh a bit on investors' minds when you are investing, because we're going to see the true effect of the big picture of the regulatory risk in 2021 financial statements, which are not out yet, will probably only be out in February of 2022. So profitability, it's a bit of a no for me. It is profitable, it's grown, but it shows that it's growth in profitability, stabilization of margins, growth in margins. It's more of a reaction rather than an indicator of profitability. And you have to consider the fact that market risk, product risk, and regulatory risk having a huge effect and are weighing this company down. So you need to consider all of that before you put your money into this. And that also kind of shows you that profitability in the near term, so after 2021 onwards, it might be a bit difficult. Alright, might be a bit difficult. So profitability for me, it's a bit of a no. Return on equity. Boy, bit lackluster. Well, not bit, very, very lackluster. The return on equity, ability of Baidu to turn shareholder capital into returns, very, very inefficient. I mean, it has outperformed the S&P 500 for 2018 and 2020. Those were the 3 years. 2 of the 3 years, it only outperformed the S&P in 2018. 2019 underperformed, 2020 underperformed, and in average is also underperformed. The S&P returned 13%, Baidu on average 29%. So it's not been very efficient in utilizing shareholder capital in providing returns. So again, that also shows you from a profitability point of view, the company is not very efficient. Very, 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 very worrying. Current ratio, not the balance sheet of Baidu, even though its profitability is worrying me, should still be good. Should still be good. Should still be very, very, very good. Because remember, asset light, cash heavy industry. So what I see is a good current ratio driven mainly by the heaps and stacks of cash on the balance sheet. Very good. On average is 2.7. 2020 it's about 2.7 as well. So about 2.8, 2.7. So 2020 is 2.7, average is about 2.8. So still very good, So for each short-term current liability on its books, it has two liquid short-term current assets to cover said liability. So very good. It shows it's in a good liquid position. Balance sheet in a good liquid position. But smaller than was this Alphabet and Meta, but you look at revenues, they're not that much. What is it, 16,000 in 2020? So that will be at a million. That will be 16 billion. So it's very small, considering Meta's revenue is about 86 billion in 2020. Alphabet's revenue in 2020 is about 186 billion. So it's still very, very small compared to the big boys. Still very, very, very small compared to the big boys. So you need to always consider that when you want to compare the current ratio of Baidu to that of Meta and Alphabet, but it's still very, very good. What I would expect is that, like Alphabet and Meta, I expect it to have cash flow, which it does, and I would expect that cash to drive the balance sheet to be in a very solid position, which it does. From a liquidity point of view, this is good. This is very, very good. Above 2, it's very good. Shows the company is very liquid, driven mainly by the stacks of cash it has on hand. Debt to equity. Ugh. Okay. A lot, but debt to equity, so for each dollar of net worth Baidu is worth, it only holds 77 cents in debt. Again, considering on average a good ratio would be 1 to 1. In this industry you'd expect it to be 1 to 1 because it's so cash heavy. But the fact that it's so cash heavy and it's still borrowing so much money, you can read it with the fact that competitors are eating into its margins and eating into its market share. So it is borrowing quite a lot to be able to compete with the competitor. So yeah, I can live with it. I can live with an increase in the debt to equity ratio as long as it's effective and productive. But it isn't, because you look at the debt to return or the risk to return relationship, Baidu on average has a debt to equity of 77%. In 2020 it has 77%, but it's only returning on average 9%. In 2020, 13%. So shareholders are taking on a lot more risk. The pretty minuscule return. Ugh. So that worries me a bit. The fact that the debt to equity is quite high, returns are still substandard, margins are good, but that's more reactive and due to cost control. Revenue is very lackluster, very mediocre. So again, still good. The balance sheet is still good, but I mean, are you using this balance sheet efficiently enough to realize returns? No. So good balance sheet. I mean, it's fantastic. It's still good. It's not as good as in Alphabet and Meta, but it's still good. I mean, it still has for each dollar of net worth, we hold 77% in debt. So it's still good, but not efficient use of the balance sheet in my view. So balance sheet very good, but not happy with how it's being used to return capital and to provide returns and to grow the company. Cash from margin, so at liquidity. So okay, I'm not talking about liquidity in the balance sheet and the liquidity again in can it turn operations into cash. So liquidity, it does mean two things. You've got liquidity in the balance sheet, and then you've got liquidity again in terms of cash generation. All right. So now we're talking about liquidity in cash generation. Can it generate cash? So is it a liquid company? Can it generate cash from its operations liquid? So you got the balance sheet liquid, it's the operations liquid. Yeah, boy. Yeah, boy. Somebody look at this donkey's breakfast. Not good. It's been declining. Um, not good at all. So from 2018 to 2020, the cash from operations margin, so the net cash from operating activities margin, two terms mean the same thing. I just use cash from operations margin because it's much shorter and you can see it. I mean, it's just much shorter and less of a tongue twister. Net cash from operating activities a bit longer and a bit of a tongue twister, but two things they mean the same thing. The margins have declined dramatically. They have depreciated from 35% in 2018 to 23% 2020, average of 28%, but they have really declined. I mean, this is really bad. So number one, it does show me that the company can generate cash from its operations. So for each dollar of revenue it has, it still generates about 23 cents or 23% into cash. Very good, because it can turn operations to cash. What is very bad is the depreciation, the decline, the deterioration, the absolute donkey's breakfast. That is bad. You went from 35% to 23%. That is very bad. It is worrying as an investor because it tells me that your margins are decreasing. Why are margins decreasing? Why is your operations decreasing? Why are you generating less cash? That means your business model is unsustainable. Your business model is not productive. It's not geared towards long-term prosperity. All right, you're borrowing a lot. Your borrowing base is relatively high, but your margins are still decreasing. So I mean, if you're borrowing kind of a lot, you have sufficient cash. So you have enough cash resources to basically stabilize your margins, protect your your market share, and grow your market share and diversify into other businesses to reduce product risk. So you have enough cash to do that, but your margin is still decreasing. So that to me as an investor is worrying. It is very worrying. The sheer unproductiveness of using cash resources, the balance sheet, to safeguard, rescue, protect, maintain your margins, that to me is a bit worrying. And that to me tells me that market risk and the fact that competitors are eating into your margin and product risk is having a bigger effect on Biden's operations than previously thought. Out of that, yeah, there was a slight deterioration, but it was slight. However, they still had a good balance sheet. They weren't borrowing anymore, and they still had significant cash on hand. Significant cash on hand. So this is worrying too. But a bit worrying. Well, not a bit. It's very, very, very worrying to me. As an investor, this is very, very risky to me. I'm taking on a lot of risk for subpar, lackluster returns, reactive uh, financial performance compounded by really minuscule revenue growth. Yeah, you grew the net income over 7,000%, but that was more reactive than anything because you just decreased costs. And on top of that, you're giving me substandard decreasing cash flow margin. That is bad. And things are made a bit worse by the fact that the company does not have a sufficient cash flow on hand. It's below one. So, but again, is that can be explained by the fact that your margins have been declining. So, I mean, if you have less and less, if you're making less and less and less cash from your operations, which Baidu is, you're gonna have less and less and less cash to fund operations. And that's if you have less and less cash to fund operations, that's gonna mean you have to borrow more. So again, that explains the increase or why the borrowing base or the debt to equity is so high with Baidu. It's making less cash, meaning it has inefficient or not enough, not sufficient cash to fund operations, and it has to borrow more to close that gap. Again, that to me is a bit worrying. It does provide returns, but I mean, again, I'm of the view that why you paying 54% of your net cash from operating activities in the form of a buyback when you could pay less, or less than half of that, well, about 40% of that, well, less than 40% of that. You can pay less than 40% and use the return and use the risk to bolster your sufficiency of cash flow and reduce your financial risk. And reduce your financial risk. Reduce your financial risk. I mean, so that's the question. That is the question. You have to understand that this high debt itself will eat into margins in the form of interest expense. That's kind of yeah, it was kind of difficult to determine by these interest expense because they netted off with interest income. The balance sheet struggled. I spent a lot of time trying to look for it, but yeah, struggled with it. Um, but either way, going back to the main point, you know, this means it's too high. I mean, you can spend less, bolster your sufficiency of cash flow, reduce your debt to equity ratio, and bolster the balance sheet by having to borrow less and spending more on interest expense. So yeah, yeah, this is not a very 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 good use of cash in my view. It's not a very very good use of cash. I mean, yes, I mean it's good. You're returning a lot of money to shareholders, but this probably looks to me like you're just trying to get a reaction out of the stock than anything. So I mean, not a very efficient use of cash. Could have been used better, but it does pay. What is it? Buybacks to shareholders. So we'll have to compare kind of a company to extract more um, meaning from it. See how does it pay relative to other companies. But yeah, I'm not happy with that. Now look, Baidu I don't think is going bankrupt. I mean, Baidu's not going back. I don't think it's going back. It doesn't look like it's going back. It's still in a strong financial position with a very solid balance sheet. However, it's not using its resources efficiently enough to grow operations, as well as not using cash flow sufficiently enough to grow, the top and bottom line. So not happy with this company. I'm really not happy on all levels. Um, you can see the stock price has just been an absolute wood chipper for shareholder money, destroyed shareholder wealth. But a lot of this, you can see the decline started roughly around about what 2020, 2021, 2021, late 2020, late 2020. And then you can see right about here in April, that's when the crackdown happened. That's when the regulatory crackdown really happened. So, you need to be very careful, when investing in Chinese stocks, especially considering the massive risk that exists because of the regulatory crackdown. But at the same time, it's not been performing as good as I would want it from a financial point of view. But it's still good because look, these Chinese companies are still good because Baidu, in this specific instance, they're very good because they give you exposure to China. However, with that exposure to China, now as we've seen in 2021, comes with a heavy dose of regulatory risk. And that regulatory risk could mean that, for example, companies like Baidu are put in a box and are not allowed to grow as their Western peers might be growing. So yeah, the regulatory risk for me kind of turns me. The regulatory risk, countered with the fact that it's not being that efficient using cash flow and resources, kind of turns me off these companies. They kind of turn me off these companies, that Chinese companies in this view. I have been burned by some, not Baidu, but I have been burned by some Chinese companies, especially at the height of the regulatory crackdown. So, I mean, it's a good company in a sense of you get a feeling that it can just stabilize margins and get some market share and start competing with some of those big boys that are eating into its market share, that it can give you solid returns. But its job has been made a bit harder by the regulatory risk. So as you can see, it's been really knocking. It's been a wealth destroyer. All right, that's Baidu. Weibo, another Chinese company. Let's see this one. What we got? So net income margin. Let's look at the profitability. Before I start, Weibo is basically Chinese Twitter. Chinese Twitter. It's basically Chinese Twitter. All right, financial performance. Yeah, same thing with Baidu almost. Actually, exactly the same thing with Baidu. I mean, it kind of shows you there's a pattern going here with Chinese companies. Declining margins. Again, can be explained by number one, the fact that other, on top of other social media sites, in Weibo's case, even Baidu and other social media ad-based platform sites are starting to eat into Baidu's, into Weibo's margins. Now, you have to understand these companies have grown to such an extent that they're now not only competing with each other, but they're competing with, for example, regular television. And streaming sites are coming on play. So they're and gaming as well. So they're competing with a lot of other smaller players for the same customer, for the same ad dollar. And that would go a long way to explain the declining margin. So Weibo declining margins, not good. Increase in competition, increase in competition, as well as product risk. The fact that it gets most of its revenue from, it's microblogging, it's so-called Twitter side of the business, ad-based revenue, basically. That's where it gets most of its revenue. So, like Baidu, market risk, too many competitors competing for too few advertising dollars. Starting to eat into each other's lunches, into each other's margins, as well as product risk. Not that diversified. I mean, Weibo is trying to diversify into other segments, but quite a lot of its revenue still comes from ads. So that's gonna make competition. That's gonna make that's gonna lead in the short term to a lot of pain. So deterioration, you can see deterioration in the margins. Looking at the cost side, you can see the fact that cost of revenue has been decreasing. So you can say good cost control, the fact that they're reacting to the fact that margins are declining. So spending high levels or a sustained high rate on a certain cost of revenue is unjustified. So decreasing it. R&D growth has for the past years 2019 2020 been stable. All right. Trying to keep it stable, not trying to basically, you're trying to get good cost control, but you're not trying to lose pace with the bigger boys. R&D as a percentage of revenue, roughly, it's been increasing at an upward trend. All right. That tells me you're still spending significantly on R&D. That one can be happy with. Now, is it justified what you're doing? That could be another question, but you still need to spend on R&D, not to lose track, not to lose pace with the bigger boys. So, is it justified? No. Looking at the fact that you're spending so much on R&D, you decrease cost of revenue, you're still spending quite a bit on R&D, you're still spending a significant amount on sales and marketing. Now, sales and marketing as a percentage of sales is at 31, 26, 27%, average of 28. The industry average for these companies with regards to sales and marketing as a percentage of revenue is about 25%. Weibo's paying 28%, but revenues have been declining. And net income has been declining. So this high level of spending on sales and marketing is clearly not justified. And you're spending quite a lot of money on sales and marketing for declining revenue, declining net income, and depreciating margins. So that is very worrisome. That's a no-no. Spending on R&D as a percent of revenue is still quite high, even though your revenue are declining. That's a bit worrying because you're not efficient. General admin cost, the growth of it, you can see there's a massive spike in 2019, but a significant downscale of it in 2020. So, costs have gotten a bit out of hand in 2019, but Weibo has reined them in 2020, which is very good. So that's a good positive. You're realizing you're spending way too much and costs are not justified. But there are other costs where Weibo is still spending a lot, and it's not resulting in growth in the top and bottom line revenue and net income, and the margins are not being protected at all. They're still declining. So that to me worries me a bit, that they're not efficient in their costs. Their costs do not just, the increase in cost does not justify the way the company is actually performing. Furthermore, in 2018, there was interest expense. It was about 15 million, but in 2017 there was nothing. So obviously you cannot get the growth of that because it's 15 million divided by nothing over nothing is, well, nothing. So, but just know there was interest in 2018, but the increase of that is quite different. Well, you can't calculate it. Well, yeah, you cannot calculate it because the denominator is basically zero. But there was an increase. Just know that. So you went from zero in 2017 to something in 2018, and then it started, and then of course it's been increasing at a very high rate ever since. And that will be justified by the debt to equity ratio when we get to it. So the high interest expense growth has also been eating into margins. So you're borrowing a lot, but is this borrowing justified? Not really. It's eating into your margins, not increasing growth, not increasing revenue, not increasing net income. Net income has been declining, sales have been declining. I mean, net income has been a mess. Sales are a mess. Costs are eating into your margins. Higher costs are not justified. These higher costs are not justified because your margins have been declining. Your revenue and net income has been depreciating at a very rapid pace. You increased your borrowing base, which is eating significantly into your margins. And you look at those costs, 94 and that is just horrific. So from a financial point of view, it's really doing bad. Return on equity. Hope it will give us a very. I hope it will give us some, good news, and it doesn't. Um, Return on equity has performed well, bad, horrific. Um, Weibo only managed to outperform the S&P one of the 3 years. I mean, on average, it's managed to outperform the S&P because the S&P only returned 13% and Weibo returned 26%. So on average, it's managed to do good. But year to year, in 2018, it was the only way to overperform the S&P. In 2019, it underperformed. 2020 also underperformed. But in average, in total, it did overperform. And it gives you a mixed result. All right. Now, if you read that with the rest of the profitability analysis, it's been underwhelming. So on average, yeah, they've been very good utilizing shareholder capital. But on a year-to-year basis, reading everything together, the whole profitability analysis together, it's been underwhelming. It's been underwhelming. The margins are not healthy. The top and bottom line continues to significantly decline and depreciate. Certain costs are not justified because they're eating into margins, and they're not being justified because said margins are still declining, revenue is still declining, net income is still declining. So it's a bit of a mess. From a profitability point of view, I'm not happy. I'm not happy. I mean, good, they've managed to stay profitable and they're still getting quite strong margins, but the trend that I'm seeing is quite horrifying in my view. It's not doesn't give me a lot of confidence. Current ratio. Current ratio. Very good. Very good. Now, remember, Weibo operates in the social media ad-based platform industry, which, as we discussed earlier, is very asset-like but cash-heavy. So you do expect a good current ratio. It's been increasing, and that's been because of the fact of the cash generated through operations, plus the fact that it's been borrowing quite a lot of money. So it does have a significant bit of cash on hand. So this is very good. 5 to 1, meaning your assets exceed your current assets, your short-term liability. Sorry, your short-term assets exceed your short-term liabilities by 5 times. Very good. Very good. So liquid. So the balance sheet is liquid. This indicates me the balance sheet is very liquid. It has enough cash to weather any storm as well as to pay your liabilities. Debt to equity, however, paints a very worrying picture. Debt to equity shows me the company has added a lot of financial risk, a lot of credit risk. It's taking on a lot of debt. And it's been increasing. In 2020, that means for every dollar of net worth I have, I hold $1.23 of liabilities. So my liabilities exceed my net worth by a factor of 123%. That is not good. That is not good. But again, it does explain the massive increase in the borrowing base. We're taking on more debt and we're paying on more expense and we're paying more interest expense, but revenues are still declining, the income is still declining, the margins are still depreciating, still earning lackluster returns. Mm-hmm. So yeah, increasing financial risk for none of the reward on the financial performance. Because margins still declining, the top and bottom line is still declining as well. So taking on a lot more financial, so taking on a lot of more financials, a lot more credit risk, and it's not really being realized in terms of profitability. I'm not happy with that. Not, not, not happy with it. Not, not, not happy with it. Oh, all right. Again, looking at the debt to return relationship, increasing debt, increasing risk, decreasing return. It's not good. That is very, 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 very not good. That's a lot of very that I said right there. But yeah, I mean, uh, the debt degree does not instill a lot of confidence. So overall, on the balance sheet, I'm not against the increase in debt. It's just that it needs to be justified. As things stand, it isn't. But anyway, let's read further into analysis, and maybe we can we can justify that increase in debt, or the company's information, financial information justify that debt. Now at liquidity from operations. So how liquid are the company's operations? Liquid is Weibo's operation. Cash from operations margin. It's been increasing. It's been increasing, which is amazing considering the margins have been declining, but it's been increasing its ability to generate cash from revenue. Okay, that's good. All right, that's good. Your margins are decreasing. That means the operations are strong enough that you can generate maximum value of cash flow from each dollar revenue you generate. So for each dollar revenue generates, it makes about 44 cents or 44% in the form of pure cash. Good. Very, very, very good. So how are you using these good margins? So how are you using these good margins? Well, basically stabilize your platform, your operations, and continue to strengthen them. Looking at my sufficiency of cash flow, like that tells me it's a bit of a worrying trend. Now, what this tells me is, okay, you do have sufficient cash flow, but it's been depreciating very rapidly. 20. Again, that is understandable considering you are taking on a bit more debt and you have taken on this debt with the intention, with the view to grow and expand your operations. So, okay, so slight decline, but still good. You still have sufficient cash flow to pay the debt holders, return some money to shareholders, as well as fund operations of investing in the company. So we're investing in itself. But what do I see? See a depreciation, see a high cash margin, compounded with a decrease in my debt to equity, the added financial risk, substandard market returns, depreciating margins, revenue, and net income growth. So the company is generating a lot of cash. Unlike Baidu, which had decreasing margins, Weibo has increasing margins. But it's not effective with these increasing margins because you're borrowing a lot, you have sufficient cash on hand, you have enough, well, the platform has enough in itself. The operations are so good that they're liquid enough to generate a significant um, part of cash from it. You have sufficient cash, but yet margins still decline. So I mean, it's a very interesting investment. It was a very interesting investment case. Good margins, sufficient cash flow, but declining net income margins, declining revenue, declining net income growth. So this, as an investor, is a bit worried because what it tells me is that Weibo is not very attractive. It's not very attractive from an investment, from my investment point of view, because you're wrecking the balance sheet when you have sufficient cash on hand. Why do you need to borrow more money when your margins are in decline, but you make enough money from your operations and you have sufficient cash on hand? Why are you adding more in terms of debt? Because if you are adding more in debt, but the margins were improving and net income was improving, revenue was improving, your returns were above market, that would be okay. But you don't have a hole in funding. Weibo doesn't have any hole in funding. Operations are liquid enough. Does it really need to borrow at such a rapid rate to a point where debt is 123% of net worth? So these are very scary numbers to me. Reading them together, it's very scary, showing me that Weibo is not very efficient in utilizing its cash. The strategic allocation of its cash to add shareholder worth to improve profitability has not been very efficient. So it's not spending money in the right, and where it is spending money, it's not generating enough benefit to justify said expenditure. So I'm a bit worried. I'm a bit worried as a shareholder. I'm taking on a lot of risk for no real efficiency actually with Baidu, with how it's used um, its great ability to generate cash flow. It's a good position that it's in from a sufficiency of cash flow point of view in generating growth in its operations. So not not really a not really a good sign. Not really a good sign. No, 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 not at all. So the main argument from my point of view is that my goodness gracious, been underwhelming. It really has been underwhelming. Um, let me gather my thoughts. There has to be something nice to be said about this company. Um, so strategic allocation, we've talked about it, of cash, not that good. It's not in its good position to actually grow revenue while reducing financial risk. And it's taking on a lot of financial risk for no good reason. Overall, again, from the cash liquidity, it will get a tick from my view. Good, but it's not being utilized efficiently. It's not paying any buybacks, which I guess one can say you understand, considering the margins are declining, no real growth, increased competition, which is eating into market share, but yet you're increasing debt, which is not really hitting operation. I mean, increasing debt to expand, but you're not really expanding, instead contrasting. You're not expanding, actually regressing. But so a question could be asked. I mean, might it have been a bit better instead of increasing debt to probably start paying back shareholders? Again, very, very poor strategic allocation and use of cash here. PE of 29, quite expensive, but I don't even need to look at the PE. I mean, the financial analysis itself really does not paint a good picture on Weibo. Really done bad. Really done bad over the past few years. I mean, it's really not been a good perform. I mean, you can see before um, really been flat. Really been flat, and in April, luckily for it, it managed to basically survive a massive drop point due to that increase in regulation. It's really been a flat performance stock, down 18%, really flat, doesn't pay any um, dividends or buybacks. Well, I would expect it to do a buyback, but I mean, it's really been a underwhelming performance. The stock price just indicates really been underwhelming, very flat. Nah, it's not the stuff for me though. Pinterest. Now, short summary. This is an image sharing social media platform, quite small compared to the other big boys, your Twitter, your Alphabet, your um, your Meta, and also in relation to the Chinese companies, pretty pretty small. But anyway, let's get into it. Net margin. Now, this is all that, but just some background, just some quick background. Pinterest is still losing money, not making any money. It's not profitable as yet. So with company like this, it's not profitable doesn't mean it's useless and it has no value. It just means it's still in the early cycle of growth. It's still in the early cycle of life and existence as a company. On top of that, considering Pinterest is operating in a very, very, very competitive market, still early on in its profitability cycle, right? You can live with negative incomes, but the most important thing to establish in a company like this is the path towards profitability. Is there a path towards profitability, or am I, as an investor, just investing in a money pit, an asset laden money pit? So let us, first of all, determine the path towards profitability. So margins, negative margin, massive pop here in 2019, but significant improvement in 2020. All right. So what picture does this tell us? All right. Let's read more with the other profitability analysis. Cost of revenue pop, massive pop in 2019, but declining in 2020. So getting costs under control, degrowth. So one can be happy considering the fact that you've gotten costs under control, which is very important for companies to use growth. You just cannot spend for the sake of spending. You don't spend for the sake of growth. You spend for the sake of profitability and growth. So okay, that's good. One can live with that. The R&D growth moved, I believe, right there. But again, massive decrease in 2020, so reeling it back in. Good cost control, I can live with that. R&D as a percentage of revenue, alright, massive pop in 2019, but I came back down to earth in 2020. spending quite a lot, you would not mind. You would not mind such high spending as long as it's justified. Um, Again, if a company is still early on in its growing cycle, so you would expect such high expenditure, especially on R&D. So sales and marketing, woof, on average, that's 38%. The industry average is about 28%. But it's difficult to argue with that compound rate of 38% when a company is growing revenue at an average of 53%. So yeah, at this stage, such high expenditure sales and marketing, yeah, looks justified. Right. So looking furthermore, revenue has grown. I mean, the growth in revenue, it's a bit unsustainable. I mean, I don't think you continue growing at a rate of what, 53% on a compound rate every year. But it's still impressive, and it shows that even though the company is unprofitable, it's using its resources and its platform well enough to generate and grow revenue, right? As well as all cost growth, where costs have been increasing, where costs are a significant portion of sales, they are justified. Okay. Now, the good margins can be attributable to, of course, the increase in cost, the increase in revenue, and the increase in cost where that did happen. So I'm looking specifically as R&D and sales marketing as a percentage of revenue, because they are quite a significant uh, portion of revenue, but that is justified. We grew revenue on top of that, so it is justified in growing revenue. On top of that, we have gotten these costs under control. We have gone to market controls and marketing as a percentage of sales, as percentage of revenue has been a decreasing rate. The same can be applicable to R&D. R&D has decreased significantly. Costs of revenue growth has also been increasing but at a decreasing rate. So we've gotten costs under control. So getting costs under control, significant costs justify growth. All of that together have enabled not only the growth in net income, but also the improvement in the margin. Return on equity is negative because again the company is not making any profits, but it has been improving. It's at -1%. So that should just give you an indication that the company is probably 2 basis points away from profitability. So it's literally knocking on the door. Profitability is not that far. And that is again justified by the fact that margins have improved, costs have been under control. Costs have been justified by the fact that revenue has improved, net income has improved due to the fact that margins have improved, revenue has grown, as well as costs are being reeled in, and they are justified. So where a significant part of revenue is being spent in the form of a cost, that cost can be justified. So Pinterest is not growing for the sake of growth sake. It's growing for the sake of growth and profitability. So as things stand, there is a clear path towards profitability. However, the question could be, is it sustainable? Considering in 2020, everybody was indoors because of lockdowns, and companies like Pinterest, these social media ad-based platform companies were using a lot of them in lockdown because we were trying to keep ourselves busy and preoccupied. So the question could be, is it sustainable? And I think that question could be answered in its entirety in the 2021 financials. But as things stand, I am happy with the path towards profitability. However, it's still a bit of a risky company to invest in, a company that's making no profits, negative margins, negative return on equity ROE. Even though it is growing at a very healthy rate, it is improving its net income, it's getting costs under control, costs are justified. by the fact that revenues are increasing and the income levels are improving. The question is it sustainable? But there is a path. There is a path. It's still a bit of a risky play, and as an investor, you will need to ask yourself a question: are you comfortable taking on this much risk? Okay, now let's move on. I'll ask that question once we've gone through the other analysis and matrices. Current ratio, again, this company does operate in a very asset-light, cash-heavy industry. So you would expect these margins to be pretty good. You would expect, very good, good, good current ratio. Now, again, this ratio kind of takes the risk a bit down because what this ratio is telling me, right together with the debt equity ratio, more on that in a few seconds, is that this company is making Pinterest is making a lot of cash, and as of 2020, it had something like $1.7 billion in cash and other short-term liquid securities. So this is incredible. Considering this company is still in the growing phase, still not making any profits, negative margins, but it has a solid and liquid balance sheet that can springboard it, that it can use as a platform to stabilize operations and to basically generate um, future prosperity. So this is very good. This is very very good. It has a very very liquid balance sheet. So 2020 in 2020, for each current short-term liability, Pinterest had 11.5 liquid assets. So liquid current assets exceeded liquid current liabilities by a measurement of 11 point. That is awesome. I mean, that is just fantastic. Again, a liquid balance sheet shows me it has enough cash on hand to use as a springboard to rapidly expedite the path of profitability, as well as it tells me that this company is not burning through cash. That I'm being told by the fact that my debt to equity has significantly improved, and that is due to the fact of the high cash it has. Now, a lot of this cash, and a lot of this cash is probably due to the fact that of the IPO receipts. But still, I like it. I love it. Has enough cash on hand, a liquid enough balance sheet to springboard itself into profitability, and is not taking on any additional risk. Financial risk is very, very, very low. So debt to equity means debt is only a measure of 16% of net worth of Pinterest. So each dollar of equity net worth Pinterest has, debt only represents 16% or 16 cents of that. So this is very good. It shows me it's not just burning through cash, just borrowing, and not knowing what to do with that money. It has a liquid balance sheet and low liabilities. I love that. And I love that. This shows me that this is a very, very, very strong company that has a strong balance sheet, a liquid balance sheet that doesn't have a lot of credit risk there. Good. Now the operating margin, so the cash from operation margin, looking at our liquidity, looking at our cash liquidity, significant improvement. Still very very poor. Um, it's still very 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 poor. My goodness, it's poor. Man. However, it's a positive. So what this tells me, 2020, the company, well, from 2019 actually, the company has been generating cash from its operations. So for each dollar of revenue it makes, it converts 2 cents or 2% into actual cash from operations. Good. I mean, it is bad. I mean, pretty mediocre, but it's good. I mean, it does show you that at least it's actually making cash from its operation. So the path towards profitability is very near. You're still taking a lot of risk though. Still negative margins, it's still 0.06% now 2% of cash margin. You're still taking on a lot of risk. But the good news is it shows you that the company is very, very near towards the path of profitability. Sufficiency of cash flow below 1. So what this tells me that the company does not have enough cash flow to pay debt, reward shareholders, and by investing, or well, allocate funds to invest in operations. Doesn't have that much. But again, remember, we are looking at the path towards profitability. So is it at least a positive? I know it's not a very high bar to cross, but is it? Yes, it is at least a positive. There has been significant improvement over the years. So reading the the cash flow ratio, the cash flow analysis, the company is, its operations are liquid. They're at least making some. It doesn't have sufficient money, but that's okay because I mean it raised a lot of money in its IPO, which you can see being carried over, it's being carried over the years, and it's not having to borrow a lot. So that IPO has enabled the company to have a strong liquid balance sheet without borrowing, even though it's not generating enough in my view cash from operations, and it does not have sufficient cash to fund operations. That IPO war chest was enough to keep the company solid and liquid, as well as less of a financial risk in terms of adding more to debt. So what's positive is that yes, there's a path towards profitability. The company's not burning through cash. And I mean, 2018 was burning through cash with a negative sufficiency of cash flow, but now it's not necessarily burning. I mean, still as a whole in its operations, but it's not burning through cash in the form of a negative. So it's making money from its operations. It does have some cash flow, not a lot, not nearly enough, but it does have some to show that it does not need to borrow too much. It does not need to always go and ask, cap in hand to shareholders for money. It did it once with an IPO. That money has plugged the hole. It's not resulting in adding on significant debt. It's clearly has some liquid operations. It does make some sufficient cash flow, not nearly enough, but it does make something. So overall, yeah, it's a risky trade, but in this company, you're not necessarily investing on the fact that it is profitable. You're investing on the fact that in the long term, looking at our analysis, looking at its profitability, looking at its balance sheet, looking at its cash liquidity, it is near the path to profitability. So basically, investing in a company that's closer towards the path of profitability. Not paying any dividends or doesn't have a buyback yield makes sense. Not making any money. It's not making anywhere near enough money to do that. So that's understandable. That you can live with that. I mean, that you do understand because making any money. So you do expect it in the short to medium term. You do expect that the company will not return. You expect the pension will not return anything to you. It's going to use all of its cash. It's going to use all of its liquid resources to basically expand and grab onto its market share. The P ratio, remember, it's not making any profits. So this P ratio is not necessarily price to earnings, but price to sales. So we're valuing the expensiveness, the affordability of the stock on a price to sales basis. So we're looking at for each dollar you invest, so for each dollar of sales you make, how much are you paying? So you're paying 23 times. So you're paying $23 for each dollar of sales the company makes, which is quite high, for a risky company. Again, it depends on your personal view as an investor. Do you think 23 sales is high or not? I think it is. I think it is. I mean, don't get me wrong. There is a good story about Pinterest. There's a good story. There is a valid case for bullishness. The fact that it is near towards profitability, it's on the path of profitability. But I'm taking on a lot of risk when other companies don't give me as much risk and give me a lot more. So based on that, I mean, there is a case for bullishness, but I feel like the fact that I'm taking on way too much risk, that for a company that's not yet making any money or not making enough money to fund its operations, that's a bit of a no. The stock price, whew, man, it has just been beaten, and that is mainly because you can see this. The beating happened here in 2021, and that's when it became clear that, well, people aren't spending as much time on their devices on the web as they were back in lockdown in 2020. As the vaccines became available, as more and more countries and regions started to control the spread of COVID, it became very clear that people are spending less and less time inside. People are more free. People feel more empowered. People feel more safe to go outside. So, ooh, 54%. You've lost half of your value. And it's been a bit of a wealth destroyer, but again, high risk, high reward. I mean, you took a high risk investing in this stock. So, there's also, you can get high rewards, but the high reward also comes with a high risk, and this high risk is the 54% decline in shareholder value. Okay, enough about Pinterest. Twitter. Oh boy. um, yeah, I mean, Twitter's a disappointing start for me. It really is, but yeah, you will see why. Um, Twitter, microblogging social media platform. Margins. I mean, that just speaks for itself, doesn't it? That really does just speak for itself. Um, Twitter's margins have been in decline, and you know, earlier on, in the previous analysis, I think with Alphabet and Baidu, I said that declining anyway, but I said declining margins are not a problem as long as they can be justified. You know, as long as they can be justified. But they shouldn't be like a massive deterioration like we have here, where you go from 14% positive margin to a negative 1% margin. This is just horrifying. This is really, really, really horrifying. I mean, this is a clown circus of horrifying. It's laughable, because you know, Twitter has just been shooting itself in the foot and hitting itself, with a pie in the face every hour and every second. But anyway, this is just horrifying. This really is horrifying. Now, what's the reason for this? There's a lot. Let's start with the obvious one. The obvious one is Twitter, unlike Facebook and Alphabet, has kind of refused to diversify. You know, Meta, I said Facebook again, so wow, the mispronunciation jar is really filling up. So Meta has diversified. Yes, a lot of its revenue still comes from ad-based services. However, it is using its platform as a springboard to diversify into a myriad of other industry, other revenue sources. Same thing with Alphabet. However, Twitter has just refused to do this. And we will get into that more with a very um, heartbreaking example of Twitter. So to refuse to diversify, on top of refusing to diversify, it's very small compared to the billions of users. I think it's 2.6 billion or so users use Facebook on a monthly basis. And Twitter's daily active users are still in the high hundreds of millions. I think they call it monetizable daily active users. So monetizable daily users, call it that. Um, that is in the high hundreds and millions of something. It's under 200 million. It's actually between 100 and 200 million. And yeah, compared to the billion user juggernaut that is Meta, the company formerly known as Facebook, that's pretty small. So Twitter has kind of failed to reinvent and diversify its platform. And that has resulted in some of the big boys eating into its profit and market share. Furthermore, going back to our analysis, been growing at costs have been growing at a pretty upward trend. Um, Cost of revenue has been increasing at an upward trend. Growth in R&D has been increasing at an upward trend. This is despicable. How do you spend 2%? How do you only grow R&D by 2%? Especially in 2018. That is just a no-no, and that kind of also gives an indication of how far Twitter has lagged behind some of the bigger boys. That it really should have not spent. They should have spent a bit more on R&D. And you can see, over the coming years, it has been basically playing catch up. R&D as a percentage of revenue, playing catch up. Sales and marketing, but on a high end, increasing at an upward trend. The average for this industry is about 25%, and Twitter is spending exactly 25%. So spending on the high within the industry average, but it's on the high end. And the question is it justified? I mean, you're spending 25% of your revenue on average on sales and marketing, but your revenue have been declining at a rapidly disappointing trend. They've been declining rapidly. So your cost of revenue, I'm sorry, your sales and marketing cost is on the high end, but revenue has been declining. So you're spending way too much on sales and marketing, which are not justifying your revenue growth. Your revenue actually decreasing. Spending a lot on R&D, spending a lot on cost of revenue, and that is not filtering down to your top as well as bottom line, so revenue and net income. Margins are still declining, so your costs are not justified. You're spending a lot, but we don't see it. We don't see the fruit. We don't see the realization of that spend in the revenue, the net income, and the margin. So a bit of inefficient spend here by Twitter. I mean, it's still a $3.7 billion company, but one cannot help but wonder if it could not be more, and it could be more. Now, interest expense that has eaten also a bit into margins. I mean, the interest expense has been a decrease in 2019, but upward tick in 2020. So it's been quite high. The growth in it has been quite high, 14% on average. For a company like Twitter with the significant cash resources it has, does it we need to borrow? Okay, maybe it does. Considering it's a bit behind the big boys. Okay, but it's borrowing a lot. But I don't see it in the margins or the growth in the net income or the revenue. I don't see it. Now, yes, understand that when you do borrow, it might take time to realize the fruits of this increased expenditure that you've added to the financial performance of the company, that you've added to the company in the form of increased expense. I mean, because the margins are declining, you get eating a bit into your margins, and your net income is declining. Oh boy, look at that, 113. So you're eating a bit into your net margins. You're eating a bit, and it's not justified. And it doesn't look like it's justified because all this expenditure that Twitter has been engaging on, it looks like it's just to plug holes rather than to actually use this cash, these resources, to actually make a solid push to take on some of the big boys. Twitter does not really make any significant, I would call it like a YouTube or like an Instagram kind of elephant purchase, like what YouTube was for Alphabet, a company formerly known as Google, and IG, Instagram, was for Meta, a company formerly known as Facebook. So you're growing, your interest expense, and we can see that you are growing your borrowing base, but all this is just to plug holes. Now, not really to expand the platform, not really to expand the company itself. So a bit worrying, increase in risk, not really justified because revenues are declining, net income is declining, margins are just pathetic, they're awful. Increasing costs aren't justified because, well, top and bottom line of the margins are on a downward trend. I mean, they're depreciating rapidly. Return on equity, poor, very, very, very poor. Um, Only outperformed the S&P one of the 3 years. Only outperformed the S&P in 2018. The rest of the years, it's underperformed the S&P. The S&P 500 over the same 3-year period provided returns of 13%. Twitter only provided 3%. Not efficient use of shareholder capital. So yeah, the return on equity is very, very laughable, but that is expected considering the pressure that the margins are under and the revenues are under and the net income is under. So yeah, mediocre financial performance tends to be followed by mediocre return. Current ratio, looking at my financial position. Twitter, operating in that industry, low asset, high cash. So do I expect? Yes. So do I expect a good balance sheet? I do expect a good balance sheet, and there is a good balance sheet, and you can see, slight decrease, but I mean, well, massive decrease, but 4.4. So current liquid assets exceed current liquid liabilities by a factor of 4. So very, very good. Shows me that balance sheet is very, very liquid. Okay, the debt to equity as you can see, it's deteriorated. The increase represented deterioration. 68%, it means that debt is 68% of your net worth. I mean, it's still very good considering, it's below the 100%, a 1-to-1 factor. It's at the ratio of basically for $1 of net worth. Twitter has it only holds 68%, which is 8 cents in debt. Still very good. However, the deterioration worries me a bit. Because if I look at the relationship between risk and return, I'm increasing my financial and credit risk, but my returns on my top and bottom line of Twitter aren't that good. It's pretty mediocre. So the increase in debt is not really justified. I mean, what are you doing with all this cash, Twitter? You're not being very effective with it. Cash from operations. So the net cash flow from operating activities margin has been declining. Yeah, yeah. The silence is deafening, isn't it? How is Twitter still losing money? Is astounding, considering it's one of it's one of the big boys, but it's behaving like an IPO or a startup, that's still finding its feet. You know, but anyway, let's continue with the analysis. It's on a decline, trend. It's depreciated significantly, and that too is very, very well. I mean, yes, Twitter is still able to generate cash flow from its margin, from its operations. For each dollar of revenue Twitter makes, it turns it into 27 cents of cash, 27% of cash. So it's still making cash from its operations, but at 27%, and considering it's declining, it's very, very low. And how do we know it's low? Just look at that. The sufficiency of cash flow tells us Twitter does not have sufficient cash flow available to fund investing activities to grow its platform and its operations, to pay lenders as well as to reward shareholders. It does not have enough cash to fund its operations, which is a bad thing. Very, very bad thing. And what happens, it needs to borrow more to plug all the holes. And that adds more pressure on my margins and my net income. So very, 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 very bad. Now, this to me was a bit irresponsible in 2019. You paid 72% of your net cash from operating activities to shareholders. Good thing, don't get me wrong, it's a good thing. You want to pay your shareholders, but the question is, your margins were already declining, your net income was in decline, your revenue was in decline, your ROE was in decline. Did you really need to pay such a significant part of your net cash to shareholders when you could have rather kept hold of that money, not borrowed as much as you would have, reduced your credit risk and your financial risk, and probably improve your cash margins as well as the sufficiency of cash flow, and use that cash to basically expand and improve your platform. So this to me is a bit irresponsible. It was just basically to get a reaction of the stock price, but this should happen. Now at the PE ratio. PE ratio, now it's not necessarily a PE ratio because in 2020 Twitter made no money, made a loss, so it's trading at a price to sales. Bearing in mind Twitter is bloody too matured to be trading at a price to sales, but it is. We find ourselves having to look at Twitter as if it's a startup. Like, Thanos in the head on Twitter. Now, it's trading at a 11 multiple. So for each dollar of sales Twitter makes, you're paying 11 times above that to own the stock. Now, is that good? No, 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 it isn't. Twitter should not be trading at a price to sales. It just shouldn't. Twitter should not be exposing us to these horrifying numbers. It just shouldn't. All right. Now, Twitter has been unproductive. It's been unproductive by using its operations to generate returns for shareholders. It really has been. It's significantly unproductive, and we can see that with the declining margins and the price to sales ratio. Now, however, Twitter looks like it's turning around its operations. It has gotten a new CEO, and they're basically taking the CEO approach that Alphabet and Microsoft took, which is basically getting an outside insider. So somebody who's been with the company, who's worked his way up the ranks, but is outside of that founders group. So he's gonna come in, and knows the company because he's come through the ranks, knows the company inside and out, but he's gonna come with some fresh ideas outside that founders group. So he's gonna come with some fresh ideas, and you can see what that approach did for Microsoft by hiring Satya Nadella, as well as Alphabet with the Sundar Pichai hire. I really overpronounce those names correctly. You can see what those appointments did to those companies. They turned them into pretty average flat companies into $1 trillion behemoths. Now, do I think Twitter can become $1 trillion behemoth? Yes, 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 I do. I do believe it. However, that is going to be on how the CEO communicates his vision, executes his vision, and is allowed to turn around Twitter into basically his image, like uh, Sundar did with Alphabet and Satya did with Microsoft. So this does give me a lot of cause for optimism with Twitter. It's been a pretty flat capital destroying stock, but this appointment of a new CEO, because it's worked twice in the past. It's worked with Microsoft, it's worked with Alphabet. There is a pattern that it does work. And if applied correctly, it could work with Twitter. So I'm not a fan of Twitter at the current moment. But this CEO appointment has made me a bit optimistic and a bit bullish about Twitter. Not to put my money in it, but to keep an eye on it. Yeah. Snap. Now, with Snap, it's relatively a new company. I mean, it's a startup that just recently listed. Um, it's not really making any money. Now, for all those who will know, Snap is basically an instant messaging app and also enables people to share images and messages. Now, the margins of Snap, I expect that because I mean, it's still a very new company. It's basically a startup that just listed. So the margins are declining, and the same thing with Pinterest. Companies early on in their life cycle, the most important thing needs to be considering the path towards profit. Is there a sustainable path towards profitability? Is this company chasing growth? Or is it chasing growth and profitability? So let's identify. Mid margins have been improving significantly for the past 3 years. Very good. I like that. Now, cost of revenue has been increasing. All right, I don't mind that. All right. Now we have to distinguish with these costs that we're going to analyze. Is it a cost in chasing growth? Is it a cost in chasing growth and profitability? So you're not just going for the sake of profitability. I mean, you're not just going for the sake of growth sake. You're going with a long-term view of profitability. R&D growth. I mean, decreased in 2018, but I mean, it's been uppish in the rest of the following 2 years, 28, 19, 2020. So 2018, this would be a bit of a cause of concern. Now, I mean, still a new company, should be spending significant R&D, not easy, but okay, could indicate cost control. Maybe they found inefficiencies and they reined them in. R&D as a percentage of revenue, it's significant. Um, I do expect that. Um, yeah, you know, wow, it's a lot, but okay, it's expected. It's expected. Still new, still chasing growth and profitability. Hopefully, sales and marketing. It's been increasing, but at a downward trend. Average about 28%. Industry average about 25%. However, revenue has been growing at an average rate of 45%. So that is justified. It's basically obtaining above industry revenue growth, even though it's spending above industry sales and marketing. So yeah, that's justified. Now, the revenue growth does justify a lot of this increase in expenditure. You increase in expenditure, but what I do like is that the company does have a keen eye on not just spending excessively, reining in spending when needed, and eliminating inefficiencies. All right, I like that. It does justify the revenue growth. I like that. Net income has been growing at a bit of a declining rate, and that to me is a bit worrying. With increasing revenue by a massive factor, but your net income is, you're actually moving away from profitability. So you know that's a bit scary to me. And it is of course supported by the fact that there's been an explosion in financial risk in the form of interest expense. I mean, interest expense has exploded and has been eating a bit into my net income. So as much as you're controlling costs where you need to, increasing expenditure relative to growth in revenue, you're achieving above industry revenue growth, that's okay. But I'm a bit worried that you're growing revenue at the expense of net income. Because I mean, I would expect that should my revenue be increasing, I don't want to see too much of a significant, which I'm seeing now, decline, backward movement in my net income. Yes, you're improving my margins, but you're still far away from profitability, and decreasing my net income growth just pulls me back even further from profitability. So this worries me a bit, and it's compounded by the fact that there's an increase in interest expenditure. We can argue that yeah, it's justified because I'm increasing revenue at a compound rate and an average compound rate of 45% too, but you're also experiencing a decline. Yeah, your net income is increasing at a compound rate of 31%, but the bigger picture is that it's declining. Your margins are still very far from profitability. So the question is, with negative margins still far from profitability, decreasing net income growth, are you growing for the sake of growing, or are you growing for the sake of profitability? And this points to me that Snap is at this stage just growing for the sake of growth. It values the top line more than the bottom line. And I'm worried. The increased financial risk in the form of interest expense is really eating into my net. It's really eating into Snap's net income. Again, worried. So from a profitability point of view, Snap is not for me moving in the right direction. Return on equity. Wow, nice. Improvement, but still very, very far from returning any significant returns to on shareholder capital. So it's been declining, it's been improving, which is good, but yeah, this this cannot tell you really much because Snap is not making any money, and you do expect this. But yeah, it just shows you how risky it is to invest in a company that's not making any money. That it will not give you any returns, it will in fact destroy those returns. Looking at the balance sheet, very strong, very stable, driven mainly by the cash. Now that cash mainly comes from the debt that Snap has been, taking up because it's not making any cash from its operations. So that cash is driven mainly by the increase in debt. All right, good current ratio, happy, solid, liquid balance sheet. Current liquid assets exceed current liquid liabilities by a factor of 5. All right. However, the debt to equity worries me a bit because you're adding a significant amount of credit risk. All right. I understand. Snap is still growing, so I'm not gonna expect you know um, positive margins or positive ROEs. I'm expecting improvement and path towards profitability, but this not only adds financial risk on my balance sheet, it also adds financial risk on my profitability because it eats into my margins and makes the path towards profitability, as indicated by the growth in net income, that much harder. Not happy with this, considering Snap is burning through cash. You will see I'm reading the the balance sheet ratios and the cash ratios together, because the increase in debt, I know, is due to the fact that the company is either wants to borrow more to strengthen it does have enough cash, it does make enough cash, but just wants to strengthen its position. But Snap does not make enough cash. I mean, the cash from operations has been improving. All right. Sufficiency of cash flow has been improving, but it's still negative. Now, this shows me that Snap is burning through cash. It doesn't have enough cash to fund operations, so it has to borrow more. All right. At a point where now debt is 116% of net income. I'm sorry, 100% of net worth. Sorry for that. 116% of net worth. Now that to me is a bit scary. That to me is a bit scary. Considering the company is not making any cash. Yeah, the margins are improving, but it's still far away from generating cash from its operations. So this just highlights how risky this company is. Cash from operations margin, it's not making any cash from operations, it's actually losing cash. So for every dollar of revenue it generates, it's losing 7 cents in terms of cash. It's losing 7 cents. Now this means obviously we will not have sufficient cash available. I mean, it means it doesn't make sufficient cash. And that explains why it has to borrow more, and that explains why so much interest are eating into margins. So this tells me, the debt to equity and the cash margins and the sufficient cash flow ratios tell me that this company, Snap, it's really burning through cash. I mean, my goodness, it's burning through cash at an alarming rate. I mean, it's getting there in terms of profitability, but it's still quite far. You know, um, the market, the social media ad-based platform market, it's saturated, and that is why you've got other companies diversifying. Snap, all of its income basically comes from its ad-based platform, and it's hard to see how it's gonna. I know that there has been this push that, oh no, Snap will be a beneficiary of the metaverse. I don't see that yet, and it's not making any money from its current operations. So, how will it master the metaverse? So it's losing money at a rapid pace. It's borrowing also at a rapid pace. That as to the risk of it. And yes, high risk, high reward. Many would look at Snap and say, oh, no, no, but it's very close towards profitability. No, no, no. Pinterest is closer to profitability than Snap. And Pinterest is trading at a price to sales of less than Snap. So, whoa. So, whoa. So, whoa. And I believe Pinterest is what? 20. Yeah, Pinterest is what? In the early 20s, and Snap is in the late, almost 30. It's trading at 29. But so for me, the risk is too high. The profitability scares me because it shows me that Snap is still far away from profitability, and it's not necessarily growing for the sake of profitability. It's rather growing for the sake of growth. It does have liquidity, but that liquidity is mainly because it's borrowed a lot of money, and that adds a lot of financial risk for me. It's not making any money. It's competing in a very, 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 very competitive market. So, it's a bit of a risky stock for me. It's too risky for me. It's above my risk tolerance. Some investors will look at it and say, "Oh no, for me, it's a good company, and yes, it's within your risk tolerance. But for me, it's not within my risk tolerance." Again, it's not making any money, so it's trading at a price to sales. So for each dollar of sales Snap generates, you're paying $29 each dollar of sales Snap generates. That is very high. Twitter is currently trading at a price sale, and it's only like 11, and it's profitable in essence. So, and it actually does make money from its operations, and it does have a positive sufficiency of cash flow ratio. So, I don't get why Snap is trading at multiple highs that of Twitter and Pinterest, considering Pinterest is closer towards profitability, and Twitter, bar its dog show of financial results, it is trading. It's actually a profitable company. Now, I know some investors will, say, "Oh no, no, but on an adjusted EBITDA, on an EBITDA basis, Snap is profitable," and I don't like using that. I don't like using adjusted EBITDA or adjusted EBITDA or EBITDA to determine if a company is profitable. No, 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 no. EBITDA and adjusted EBITDA is more for when you want to value a company, and even at the end of it all, we still include expenses towards capital assets as well as debt, as well taking into account debt and of course cash on hand. But for me, Snap is too risky, and it's not profitable. So you cannot. So adjusted EBITDA and EBITDA for me are a circus act that people perform to justify why an unprofitable company is actually profitable. It's just you bending over backwards and convincing yourself that an unprofitable company is actually profitable. No, 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 no. We're looking at the finance, net income. How much net income does it? How much net income hits the income statement? That is profitability. So I don't want to use that. That is a lie. That is an fallacy in my view, an imagination fairy tale story that you tell yourself to convince yourself that an unprofitable company is actually profitable. Now, my problem with Snap is its valuation. It has a lot of risk, which I wouldn't take, but its valuation is also a major problem for me. It's trading too expensive. Alright! Now we've come to the end of this journey of ours. As you will see right now, this is basically the consolidated high level summary. So each company, their 3-year averages for each metrics. You will see this metrics, it's a high level summary, but it does kind of give you a rough idea of where companies should be performing in line with the industry and in line to each other. It's a high level comparison. because you will see an example is that you need to basically use it in line with the individual analysis that we did. The individual analysis will provide for you a better picture than this actually. And an example of that I can give you that stands out is that the margin, the industry average is 1%. That is just no, that's unacceptable. I mean, Meta, Alphabet, Twitter, Baidu, and Weibo should not be trading anywhere near that. Twitter should not be trading anywhere near that either. But as we discovered, Twitter is a disappointing child. It's as disappointing as disappointment you can get. But it should not be trading at that kind of average margin. So that's the industry average. Another example could be for R&D. The industry average is 23%. However, Alphabet is at 16%. But we know Alphabet has big returns. It has a liquid cash flow, least amount of risk. Its operations do generate a stable cash margin, and it has sufficient cash flow. Whereas if you go to Baidu and Weibo, they might spend more on R&D, still also below the industry average, but above Alphabet, but are not performing as good as Alphabet. You look at the fact it has increased risk, solid liquid current ratio, look at balance sheet, but increased financial risk, declining margin in the case of Baidu, inefficient cash flow in the face of Weibo. So this just gives you a rough idea of how each company should be operating, and I use this. I used a lot of them, in my individual analysis, just as a rough idea of how the industry should be operating. But for me, more value is given to the individual analysis because the individual analysis gives you a bigger picture. Because one would look at Alphabet and say, "Oh my goodness, it's not spending that much in R&D. It's not that good. It's not growing revenue in line with the industry." No. If you look at the individual analysis, it will give you a bigger picture that it doesn't need to achieve that because it's already more profitable, more of a stable company than companies that achieve it or exceed it. Alphabet is a better company than Pinterest and Snap. So it's just a high level overview, just gives you an idea of where companies should be operating, what's normal, what's not normal, what should companies be operating at. Now, I just want to bring attention to this. Now, Baidu I didn't like, Weibo I didn't like, Pinterest I didn't like, Snap I didn't like, Twitter I didn't like, but I did love the story of Twitter. I want to keep a hawkish eye on that. So Twitter for me, I put on my I wouldn't buy it yet. I still want to give that CEO, the new CEO, I want to give the new CEO time to implement and communicate his vision sufficiently, and I want to see that vision in practice before I put a single cent into it. So I'll put it on the watch list, but I won't buy it yet. But the two companies I was a really big fan of is Meta and Alphabet. Baidu, it's trading at a 21 multiple. Not bad, but I mean, as the individual analysis we discovered, it's not really a good performer. Weibo almost 30. I mean, it's trading at the same multiple as Alphabet, and it's not as efficient and not much of a shareholder rewarding tool as Alphabet. So no. Pinterest and Snap too risky for my view. Snap its valuation is just insane. So looking at these two, Alphabet rewards me more, and I'm paying a lot more in terms of multiples. However, Facebook rewards me a bit less, and I'm paying a bit less. However, I love the Meta. This message is really growing. Meta. Company formerly known as Facebook, Meta. Meta is only trading at 27 multiple. And for me, I love Meta. I still love Alphabet. I think it's a good company. But I love Meta just a bit more because Meta is trading at a very, very attractive level. I love the level at which Meta is trading at. It's trading very, very low. It's a very good company. It's growing rapidly. I love the diversification into other revenue streams. The fact that it wants to move away from just being an ad-based revenue service provider company, and it's moving more towards consumer electronics, streaming, gaming, commerce as well. And I love that. However, you need to consider, the effect of Apple's new iOS system upgrade, software upgrade. I think you will see with Snap, that system upgrade, the privacy upgrade, so the privacy upgrade to iOS had a big effect on Snap's ability to generate revenues. It kind of knocked it down a bit. It also had the same negative impact on Meta, but Meta is so big, like now Meta is trying to find out ways, it's diversifying into ways where it can keep you on its platform, so where you can do everything on its platform. So it's trying to reduce the effect of that Apple iOS privacy update, which will have a significant effect on these social media companies. These companies that are basically driven, whose revenue is basically driven by ads. Twitter has been very good in actually mitigating the effect of that. But it has written in its financials for 2020 that they are monitoring that effect. But so far, they have responded best from your Metas and your Snaps to that privacy update. It has affected it. It has affected Meta really badly, but not that badly because Meta is recovering. It is trying to find ways to reduce its reliance on the Apple software. That even if the Apple software makes it difficult for it to generate data and sell that personal data to advertise and make more revenue, trying to find ways to mitigate the effect of that system upgrade, that operating system upgrade, and basically continue to thrive and grow. So I do love its resiliency. I do love its diversification, even though it's in political hot water with the fact that some of its platforms have been found to be bad for humans. It's still used. Nobody's gonna blame their Facebook or their IG or WhatsApp. They're still gonna use it. So I love it. I love it. Almost everybody in the world. You can just imagine. People Facebook can target is about 5.6, 5.7 odd billion people, excluding China. Of that 5.6 billion or so, 2.6 billion use the Facebook family or the Meta family apps. Oh goodness, that mispronunciation jar is really filling up. Use it. So basically, roughly about half of the world uses Meta family apps. That's very good. That is incredibly good, and it is on top of that diversifying its revenue base. So on that, Meta is a bit cheaper than Alphabet. Alphabet's still a strong company. If I owned Alphabet, I wouldn't sell it. It's still a strong company, but I prefer Meta. Meta is my investment of the week. It just offers more value for money. All right, well, guys, thank you for joining me. Join me again next week where we will be discussing the semiconductor industry. Thank you.